Search volume for US recession is the highest it has been in the last 5 years. It's even exceeding the lows of June 2022 when the US dropped by more than 25% going into a bear market for that year. On top of that, there are still talks of interest rate cuts. So today's video, I want to give you my thoughts about a recession, interest rate cuts, what the markets may or may not do in the case of a recession or interest rate cuts, and what I think is going to happen next. So I've got lots to unpack in today's video, along with Bitcoin, cryptos, of course, the stock markets, and the real estate cycle. So make sure you hit the like button, subscribe to the channel if you're new here. This is what we do on a daily basis, covering the macroeconomics, looking at the stock markets, Bitcoin, crypto, real estate cycle, and trying to put it together for you guys so that you can feel a little more confident in how to read the markets. This is what we're getting time and time again with reviews from yourselves in the YouTube comments, just making life seem a whole lot less crazy when the world seems like it's imploding week after week. So some fantastic reviews from you guys here, from our members as well. All right, guys, we have done the intro, recession, interest rates. Where do we go from here? We're seeing it time and time again. As I showed you here, it's the search terms for Google Trends for US recession was at its peak last week. Now it's dropped off from that point, but that doesn't mean that the fears have subsided to the lowest levels yet either. So US recession pretty much up there. This reminds me of 2023. Every time there seems to be a recession, there is some sort of analyst out there that's trying to tell us that the markets do have to correct and it's just a matter of time until it all comes crashing down. And it just reminds me of this quote from Peter Lynch, which I referred to a lot in 2023 on the channel, and it was almost in a direct reference to particular pro traders and analysts out there who were very bearish on the markets, and none of that came to fruition. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. So think about that. And when I show you on the charts, it is crazy how little the recession might impact your view of the stock market if you're actually a longer term investor. Of course, I'm going to get into Bitcoin in this video as well, but I just need to explain this first up because I think it's a pretty good video that we can all come back to when more talks of recessions come up, because eventually they're all right. Remember, eventually the guys who are calling for a major recession or a crash, eventually they're right, because the markets do, in fact, come down. Going back, looking at what I was talking about in January of this year now. So 8 months ago, there is January 15th, 2024. I was looking at interest rates not coming down for the most part of 2024. Sometimes I even talked about it not coming down at all in 2024. Of course, I'm not the Fed. I'm some guy that is analyzing the markets and sharing it with you on an almost daily basis. And you can see in real time whether it is working out to a more macro degree or if it's not. And that's, of course, up to you to make your own decision. So my view was that interest rates were not going to come down. And this was at a time when the absolute masses were expecting interest rates. They had to come down. You can see here, January, March, May, June, July, they're expecting a cut every single meeting. It has not happened. Eventually, it too will also happen. So if I bring this one up here, this is the interest rate, the Fed Watch, CME Group interest rate meeting. The next one's coming up in 37 days. They didn't cut last time in July. Next one coming up is in September. And there is a 53% chance that they'll be cut by at least 0.25%. And then the following meeting, potentially 2 more cuts after that. Even September, eventually, it might even come up and they'll get an extra cut here. So this is also coming up in some of the press conference minutes here. Seth's done a good job to pull this apart. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence in considering any adjustments to the target range for the federal funds rate. So that's what we're looking at here with the interest rates. The committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Monetary policy will adjust. Essentially, we can cut interest rates. So although I've been talking many, many times about I don't think they're going to cut it, whether they do or don't, at the end of the day, I'm trading the markets, and I think the markets will continue up throughout 2024. We'll get a higher close than the open of 2024. And I think the same thing for Bitcoin. We'll still get a higher close at the end of 2024 compared to where it opened. And the open was roughly around 40 something thousand dollars. The point I'm trying to make here is I don't think it's going to affect the stock markets or Bitcoin and crypto throughout this stage of the cycle. And this stage to me is that we're still going up higher. I've been talking about this for a very long time. And of course, it's been a very big talking point. So I think the next thing we need to look at is also the recession. Recession here, number of recessions starting in the year of the presidential cycle. Obviously, another big talking point coming up at the end of this year. We've got the US election coming up in 3 months. And the number of recessions starting in the year of the presidential cycle, year 4, which is this year. This chart has 92 years of data. The 4th year is the second highest year that there are recessions. And the first year of the cycle, which would be next year, 2025, first year of the presidential cycle, that has the highest number of recessions. So do we see one in 2024 or 2025? Of course, that's anyone's guess. I don't think there is one, but even if there is one, it still doesn't change my view of the cycle. The prices are still going up. The stock market is still going up. Longer term, in the short term, we've looked at many reasons why it could be down for 1, 2, 3 months. But eventually, after that sort of 6 to 12 month period, the prices will probably be higher. And that is the time frame that I'm looking for, regardless of a recession here or a recession in 2025. Again, I'm still not seeing a recession until we get to this peak and major collapse here. So the peak could come mid or late 2025. Maybe it comes later in 2026 as well, sort of early to mid 2026. And this is for the real estate and economic cycle. So this is going to be different to whether the stock market collapses more than 20 or 30%. This one is specifically looking at the peak of the real estate and economic cycle. We're comfortably in the winner's curse phase now, and you'll see it start to roll over, I think, in the next 1 to 2 years. Just looking at the timeframes here, thanks to our good mates at Property Share Market Economics. So looking at that peak and collapse, major recession coming, that would be sometime around that 2026 or later. So still plenty of time to go just based on this cycle, which has been playing out for over 200 years. And we've seen the same thing happen in the mid-cycle in 2020. You had that mid-cycle slowdown. And then because of the money printing and everyone locked down and just how crazy it was, you had this big boom out of that particular low. So that leads us to have a look at the S&P 500 and the recessions and the interest rates and where the market goes within these recessions and interest rates. Just taking a historic look. That's all. First up, let's have a look at the percentage gains throughout the market through each of these years. And 2020 started right here. So just the open and close of the year. 2020 January into December. That was a 16% gain, 15.7 if you want to be really specific, calling it 16%. 16% gain on that year. Yes, you had a massive drawdown. So the difference here is that your portfolio would have been quite volatile. The volatility to the downside, the spring back to the upside. But if you're a longer term investor, well, that's your return for the year. 15.7% open to close. What about 2021? Well, you had another roughly 26%, 27%. There's January into the end of the year, December, 27%. So pretty decent over those 2 years with COVID in the middle. And then 2022, there was the correction, about 20% from the open to the close, and obviously further 27% total from the top to the bottom. But if you just take it back to the close, as we're doing, 19.6%. Then you take it to 2023, same deal. You had 23.8% open to close. And now we find ourselves in 2024 with the open January to the current price, about a 12.6% return. So if you're looking at this for the total of the 4 years, going back from January 2020 to the end of 2023, that return is roughly around 47%. 4 years divided by, into 48%, it's about a 12% gain a year, which is pretty incredible considering the normal annual average that most reference is roughly around 7 to 10% per annum. And over the course of a bear market through 2022, COVID collapse in 2020, and then a closeout at all-time highs in 2023, you had a 48% return, basically an average of about 12% per year. So pretty significant returns there. And we're currently already at that price now. That's just something to consider looking at the longer term views for the market, not to get too caught up day to day with all of the fearful headlines of interest rates might be getting cut, the economy is weakening, we need to see a recession. So all those things start to snowball. And I'm bringing that up because of what you guys have often said in response to Michael and I, is that we somehow pull this apart to hopefully make it seem a little bit easier and less scary than what the media makes it out to be. So that's what I'm doing here, trying to plant that seed. Now, let's look back at the last 100 and something years for the S&P 500. We'll bring out first up, we'll bring out the interest rates and just go back as far as I can here. And then I'll bring out the recessions, and you'll start to see the craziness of recessions and what they actually do to the market, barring a few examples. Interest rates, I've covered this many times on the channel, but if you've still missed it, which I know a lot of people still miss it, this one is something you can take forever. Take it in your back pocket, in your toolbox, and use it forever when it comes to your own investing, whether it's real estate, whether it's Bitcoin, whether it's the stock markets. It's because you never see this in the media, you never see it with other analysts. They tell you that interest rates go up, market collapses. And that's entirely incorrect. Interest rates are going up and the market was going up itself. You got interest rate increases. At first, maybe those first month or two, maybe the first few weeks, you get a scare where they're telling us the interest rates need to go up and you start to see the market come down. And at the time, it is the biggest deal in the world. Absolute biggest deal in the world. We know that happens over and over again with the market, and this is the biggest deal in the world that we've seen for a very long time here. You know, Japan, the Japanese carry trade, and basically the market's pulled back here, which is pretty insignificant over the long term. Anyway, the point here is that interest rates increasing, stock market's increasing. Yes, there's still going to be some corrections along the way. The interest rates can pause and the stock market can keep going up. The interest rates can come down and the stock market can keep going up, and vice versa. Basically, there is no exact science here to tell you that if interest rates go up, the market must come down, or real estate prices must come down, or real estate prices must go up. Normally though, as the interest rates are going up, you see the markets also going up because you're starting to see an overheating in the markets, whether that's the stock market, whether it's real estate. Basically, people are spending and they're trying to curb all of this spending and continue to increase the interest rates. I can take it back to the 90s, which is one of my favorite examples here. You had the recession in 1990 into 1991, so about an 8-month or so recession, some places 12 months. You had interest rates coming down and you had stock market going up. You had interest rates on pause at 3%. You had the stock market climbing up. You had interest rates starting to go up and then skyrocketing up to 6%. The stock market took a little bit of time to digest that move, and then it also started to go up at that same time. The interest rates came down a little. Stock market kept going up. And rinse and repeat. You can see it was, in terms of the interest rates, was pause and up, pause and down, pause and up. Meanwhile, the stock market kept going up and up and up. And you can basically take this back over the entirety of the stock market itself. So the point I'm making here, if there is any more fear around interest rates, and if there is an interest rate cut, maybe in the short term, you'll start to see this, and this might already have started here in August, the stock market trying to digest that move, and that would then lead to the fear that the market is peaking, and that's the end. This is the bull market, you've missed out, and you got that bear market to swallow up now, and we're going into a major recession, which leads me to the next point about the recession. All right, so let's take the interest rates off. Let's turn the recession on. Obviously, 2020, that was a quick fire, couple of months of a recession. Here is your open for the month of March, close for April, recession's over. Basically, the price is almost exactly where it opened. So you had the drop and then the pump, and it's basically the same price. The following month, it was higher. So if you gave it another month or two in the recession, the price on the stock market would have been higher, and everyone that was waiting for a further decline missed out on the low. Let's take it back to the next one. You had the recession start up here, and then it end around here. Well, you had a pretty big decline on the stock market, and as it began to climb out of the low, well, you had the recession ending, and people still expecting a further decline. Meanwhile, the stock market was going higher, and of course, the rest is history from that point. If you take it off log, you can see just how big that gain is. 2001, difficult time there. You had a recession through the middle in 2001, and the stock market kept going down from that point. So as I said earlier, barring a couple of examples, now we get into some of the more interesting recessions throughout history. And you can see the amount of green here. The green is the recession. The data goes back basically to the peak here in 1928, 1929. But the main thing I'll show you here, not to bore you with too much of this, but it's very interesting, is that you've got the recession. There is the open of the market, the dump, and then it climbs back to be higher than where it opened when the recession kicked off, right? And people will argue that, well, you could see the recession coming and they were fearing, you could see the fear was there and there was a lot of signs that it was going to come, so you should have got out of the market earlier and all sorts, right? But that's typically what happens the entire way up. And that's why I wanted to show you the 2000 example into, 2020 into 2023 example, where the stock market was still higher by 48%. And we know that everyone was still calling for a recession through this entire period. And now they're still doing it, hoping for further downside. There might be further downside. And they'll say, see, I told you, you shouldn't have got into the market. But no, almost no one looks at a price chart to look at where these levels come out at. And we're so high up, like back in the 1990s, they could have told us that the recession was coming for years and missed out on the move to the upside, only to wait for this move to the downside. I doubt they would buy at the lows, and then they would start to either buy on the way up again or miss out entirely and keep calling for a recession the entire way. It's just what happens time in and time out. Look at the next one, 1980s. This was quite a large recession. Here is around the opens, the calling of the recession, and then the end of the recession here. So it was higher. The market was higher. It had a severe decline in the middle. The world was ending. Game was over. The US was going to go into default to Mexico. Probably many don't even remember this from the 1980s. Didn't happen. High or low. Market took off from there. Next one, 1980s. There is the open. There is the close. It was higher. Big correction in the middle. The market went higher. The point for the 70s was it was the end of the real estate cycle. It was one of these picks here. You had the peak, and then you had the end of that real estate cycle. So that's something to be aware of as well, and I'll talk more about that on the channel. But as you can tell, this video is probably going long enough, and you really want to get into some Bitcoin. So, I'll save that for future videos as well. Or you could do the research yourself and have a look at how the recessions tie into the ends of the real estate cycle, or in the mid-cycle where they're typically less severe, and you eventually see those higher prices a little earlier. Not always, but normally you get to see that like we saw in 2020. All right, you had the open here, then you had the close, slightly lower, following month, basically equal price there. So I can go back and do this time and time again, but I won't bore you with that. That was my thoughts on the interest rates. Should we see a cut? And recession, should we see a recession? Of course, there is no confirmation of either yet. There is obviously talks about it, but I thought it would be a good chance to at least talk about it here, just in case we get one of those, because I've been very vocal, as you know, about interest rates and about no recession. So my job is to trade the markets. And at the end of the day, whether these things come up or not, I don't see it being that much of an issue to my longer term outlook in terms of the 18.6 year cycle and where we're heading next. And then after that, that's when I'd start to get a little bit more concerned, or a lot more concerned. How does that play into BTC? Well, for Bitcoin, it's only ever seen one recession, and that was back in 2020, and it was very, very quick-lived. So you can see the recession for March and April. There is the open, the start of the recession. There is the close, basically the same price, 8,600 and 8,500. So really, you had a very severe decline, 40, 50%. Market climbed back, and then the rest is history from that point. It just went on and on and on. So should anything like that happen, obviously we'll have to see how the market responds and how it reacts to that sort of news, whether it's a recession, whether it's interest rate cuts. But like we can see last Monday the 5th, there was the Japanese carry trade, which was heading down into the significant low at $49,000. Bitcoin has bounced from that point, and now we can start to look at things on a little bit more of a short-term basis, because my longer-term view has remained unchanged. It's still above bull market support level, $44,600. That's the halfway point between the top and the bottom. And for now, it's just in this sort of granular stage, as I talked about in last week's video for some other altcoins, where you start to see them trade between 50% levels at smaller and smaller time frames. And that is just a matter of the sellers and the buyers trying to work out where the strength actually lies. And so that starts to grind down into lower and lower time frames. You can see now from this Monday bottom to the Thursday top, the 50% level is now at 55,900. So providing we remain above that sort of mid-ish $50,000 level on a closing basis, prices can spike, but look what happened on Monday. It spiked down and then closed above 53. Then we're still in a slightly stronger stance to then test the 50% level again. And this, I think, is going to repeat throughout each of the different time frames the lower you go. Finally, start to gauge who is going to be stronger and who's going to be weaker. Is it going to be the bulls that take control, get above 50%, or is it going to be the bears that take control and reject 50% again to close underneath that $53,500 level for BTC? So as a recap, my view hasn't changed on Bitcoin. The bull market support level hasn't broken down. The signal that I brought you in March still stands 4 to 6 months below the old all-time high. That comes out in roughly September. Give it another month or so with the extent of the move we've seen to the downside and the timeframes that we saw going back in history, looking back at 2016. Some of these moves here lasted about 200 days going from that peak to the next breakout point. So I'd be on high alert if Bitcoin broke from $53,000. Otherwise, basically, it's a choppy market at this stage on top of all the economic recession, interest rate, Japanese carry trade, stuff going on with the stock market, all that sort of uncertainty surrounding these markets. Along with that is the fear and greed, obviously extreme fear for the stock market, Bitcoin and crypto's extreme fear again, which I think is a good sign here, especially considering it wasn't able to get up to the greed so quickly, and basically a bit of a churn around here in the market sentiment. Have specific invalidation levels, and some of those might be a break of 49K on a closing basis. Some might be 44.6, others might be down here at $38,500. Plenty of significant levels for Bitcoin to the downside, but of course it's not there yet. Total cryptocurrency market cap is above 50%, a good end to the week. So a nice close above 1.86 trillion. Still nothing to be overly concerned with. Closes above 2.2, 2.21 is really where you want to see this market at for further signs of strength and consolidation above that level. But while it's above 50% here at 1.87, things are looking relatively good. ETH was also able to close above the 50% ever so slightly, 2,555. The 50% was at 2,486, so a few dollars above that. So it is of the weaker out of the three, Bitcoin, ETH, and Sol now. And where I'd really like to see it is about 13% higher from the current prices. That is going to bring it back above 2,900. So that was the price target I was telling you about last week. That's for signs of strength to get back above all of these lows. If you start to see a rejection at 28, 2850, 2900 and further downside, again, putting it in a weaker position, it could still hold out and then consolidate, but it's just going to take more time for ETH to then show further upside strength and beat some of the other gains like Solana. Solana is above both those 50%, above the 50% here at 108 to the larger time frames. Basically, like looking at a longer term moving average. These are the larger moving averages, but the 50% I find works so much better to show you signs of strength, resistance, whether the stock is trading in a strong position or in a weaker position as well. And for now, I mean, Solana is showing very, very good signs here, above 136, which is a great sign for Solana after last week's quick dump. Got right down to 109 and then bounced straight back to close above those lows, whereas ETH, as you can see, was still below each of these lows here. So good signs, at least for Solana. some slight good signs there for ETH closing above that 50%. Really needs to get a move on here to get above 2900. And for BTC, providing it doesn't start to close below that 53.5, then I think it's a bit of a choppy market. So stay safe in these choppy markets. Come back to this video if you want to know more about recessions and interest rates and all that sort of stuff coming up in the media. And let me know in the comment section if you found some value from the discussion on interest rates and on recessions. Like, subscribe if you're new to the channel. I'll see you guys at the next video. Until then, take care and peace out.